When I first heard about the proposal for 50-year mortgages being floated as a solution to America's housing affordability crisis, my immediate thought was to verify whether this was actual policy discussion or something from a satirical news program. Unfortunately, it appears to be the former, which raises some fascinating questions about how we've arrived at a point where extending debt obligations across half a century seems like reasonable economic policy. The mathematics behind this proposal are simultaneously elegant and horrifying. By extending mortgage terms from the traditional 30 years to 50 years, monthly payments can be reduced by approximately 15 to 20%, making homes appear more affordable to buyers who are struggling with current market conditions. This sounds appealing until you examine what actually happens to the total cost of home ownership under such arrangements. A $400,000 mortgage at 7% interest over 30 years results in total payments of approximately $958,000. The same loan extended to 50 years would total roughly $330,000, an additional $372,000 in interest payments. To put this in perspective, borrowers would pay nearly as much in additional interest as many homes cost just a few years ago. We're essentially proposing to solve high housing costs by making housing dramatically more expensive, which represents a rather creative approach to economic problem solving. What makes this particularly intriguing from a policy analysis standpoint is how it reflects broader trends in American economic thinking. Rather than addressing the underlying causes of housing unaffordability, restrictive zoning laws, regulatory compliance costs, supply chain disruptions, or land use policies, the proposal focuses on financing innovations that allow people to pay more for the same asset over longer periods. This represents what economists might call a financial engineering solution to a structural economic problem. It's similar to how subprime lending was positioned as expanding home ownership opportunities when it actually expanded debt obligations while creating systemic risks. The pattern seems to be that when real assets become unaffordable, rather than questioning why that happened, we innovate new ways for people to take on more debt to afford them. From a generational equity perspective, 50-year mortgages create some rather extraordinary implications. Borrowers taking such mortgages in their 30s would be making payments into their 80s, assuming they live that long. This transforms home ownership from a path to eventual equity building into a lifelong rent payment to financial institutions. It's a fundamental reconceptualization of what residential real estate represents in household wealth building. The proposal also raises questions about intergenerational wealth transfer that seem to have received limited consideration. Traditional mortgages allow homeowners to build equity over time, creating assets they can pass to their children. 50-year mortgages extend this timeline significantly, meaning that many borrowers will die before their homes are paid off, potentially leaving their heirs with debt obligations rather than assets. The international perspective provides some useful context here. Japan has offered multi-generational mortgages for decades, with some loans extending up to 100 years and passing from parents to children to grandchildren. These products emerged during Japan's asset price bubble in the 1980s, when real estate became so expensive that traditional financing couldn't accommodate buyer demand. The parallel to current American housing markets is rather striking, though perhaps not in ways that inspire confidence. What's particularly fascinating about the current American proposal is how it's being framed as expanding access to home ownership, rather than acknowledging that it represents a form of debt peonage. The linguistic framing matters because it shapes how policymakers and the public think about what this actually accomplishes. Calling it expanded access obscures the fact that it's really expanded debt obligations with delayed equity building. The mortgage industry's enthusiasm for such products is entirely understandable from a business perspective. Longer loan terms mean more interest income over time, while the lower monthly payments expand the pool of qualified borrowers. It's an elegant solution to the industry's challenge of maintaining loan origination volumes in an environment where traditional lending standards would exclude many potential borrowers due to high prices. The regulatory implications deserve careful examination. Current mortgage regulations, developed in response to the 2008 financial crisis, focus heavily on borrower ability to repay loans. 50-year mortgages would likely require regulatory adjustments to accommodate the extended terms, which could mean revisiting the qualified mortgage standards that have governed responsible lending since the Dodd-Frank era. From a monetary policy perspective, this proposal creates interesting dynamics for Federal Reserve officials who are already grappling with the relationship between interest rates and housing affordability. Lower interest rates traditionally stimulate housing demand, but they also contribute to price appreciation that can offset the benefits of cheaper financing. 50-year mortgages could amplify this effect by allowing buyers to qualify for larger loans, potentially putting additional upward pressure on home prices. The actuarial mathematics underlying such long-term debt obligations present challenges that traditional mortgage products don't face. 50-year loans must account for borrower mortality risk, changes in property values over extended periods, and the potential for significant economic disruptions over half-century timeframes. These risks would likely be reflected in higher interest rates, potentially offsetting some of the monthly payment benefits that make the products attractive initially. The secondary mortgage market implications are considerable. Government-sponsored enterprises like Fannie Mae and Freddie Mac would need to determine whether they're willing to purchase 50-year mortgages from originators. Their decision would significantly influence availability and pricing of such products. Given these institutions' mandate to promote sustainable homeownership, their position on ultra-long-term mortgages could be instructive. The demographic realities of aging in America add another layer of complexity. With people living longer and working later in life, the traditional assumption that mortgage payments should end before retirement may need updating. However, the financial planning implications of having mortgage payments extend into advanced age, when healthcare costs typically increase and income often decreases, seem inadequately considered in current discussions. Looking at the proposal through the lens of household financial stability raises additional concerns. 50-year mortgages significantly reduce the pace of equity building, meaning homeowners would have less financial cushion during economic downturns. This could amplify the impact of future recessions on household balance sheets and potentially create more widespread foreclosure risks when economic stress occurs. The interaction between 50-year mortgages and inflation presents interesting dynamics. In inflationary environments, fixed-rate long-term debt can benefit borrowers as they repay loans with depreciated currency. However, the extended term means borrowers are locked into whatever inflation assumptions were built into their interest rates for half a century, creating significant uncertainty about the real cost of home ownership over time. The political economy of this proposal reflects broader American attitudes toward debt and home ownership. The idea that home ownership is so important that people should accept lifelong debt obligations to achieve it represents a particular view of housing policy that prioritizes ownership rates over ownership sustainability. This differs significantly from countries that have focused on rental housing quality and affordability as housing policy goals. The behavioral economics aspects deserve consideration as well. 50-year mortgages could encourage buyers to purchase more expensive homes than they might otherwise consider, since the monthly payment impact is muted by the extended term. This could lead to households taking on debt obligations that represent larger portions of their lifetime earning potential than traditional mortgages would allow. From a real estate industry perspective, longer mortgage terms could fundamentally alter market dynamics. If buyers can qualify for larger loans due to lower monthly payments, it could put additional upward pressure on home prices, potentially negating much of the affordability benefit that makes the products attractive in the first place. This creates a feedback loop where financing innovations designed to improve affordability actually reduce it over time. The insurance implications of 50-year mortgages present additional complexities. Mortgage insurance, title insurance, and homeowners insurance would all need to account for the extended time frames and changing risk profiles associated with ultra-long-term loans. These adjustments could affect the total cost of home ownership in ways that offset some of the monthly payment benefits. The macroeconomic implications extend beyond housing markets. If 50-year mortgages become widespread, they could significantly alter household debt-to-income ratios and change consumption patterns as larger portions of household income are committed to debt service over extended periods. This could influence everything from retail spending to retirement savings rates to economic mobility. What strikes me as most significant about this proposal is how it represents the continuation of a particular approach to economic policy that treats symptoms rather than causes. Instead of questioning why housing has become unaffordable relative to incomes, we're innovating new ways for people to afford unaffordable housing. It's a distinctly American approach that prioritizes financial engineering over structural reform. The comparison to other consumer debt markets is instructive. Auto loans have gradually extended from 3 years to 7 years or more, allowing buyers to purchase more expensive vehicles while maintaining manageable monthly payments. The result has been higher total borrowing costs and negative equity situations where borrowers owe more than their vehicles are worth for longer periods. 50-year mortgages represent a similar dynamic applied to housing markets. Looking ahead, the implementation of such policies would likely face significant practical challenges. Lender appetite for 50-year loans would depend on their ability to sell them to investors willing to hold such long-term assets. The securitization markets that enable most mortgage lending would need to adapt to accommodate these extended terms, which could limit availability and increase costs. The intergenerational wealth implications become particularly stark when considered alongside other economic trends. If younger generations are committing to lifelong debt obligations for housing while also facing challenges in retirement savings and student loan debt, the cumulative effect could be a significant reduction in wealth-building capacity relative to previous generations. Perhaps most importantly, the proposal reflects how financial innovation can sometimes obscure rather than solve underlying economic problems. By making unaffordable housing appear affordable through extended payment terms, 50-year mortgages might actually perpetuate the conditions that made such innovation seem necessary in the first place. The ultimate question isn't whether 50-year mortgages can reduce monthly payments. They clearly can. It's whether a policy approach that addresses housing affordability through longer debt obligations represents sound economic policy or simply kicks the problem further down the road while making it more expensive to solve. The tax implications of 50-year mortgages introduce additional layers of complexity that deserve examination. Current tax policy allows homeowners to deduct mortgage interest, which creates a federal subsidy for home ownership. Extended loan terms mean significantly more interest payments over time, which translates to larger tax deductions for those who can utilize them. This effectively means taxpayers would be subsidizing the additional interest costs associated with these longer loans, creating a form of public support for what is essentially a wealth transfer from borrowers to lenders. The credit market implications extend beyond residential mortgages. If 50-year terms become normalized in housing finance, it could influence other credit markets as well. Auto loans, student loans, and personal credit could all face pressure to extend terms as consumers become accustomed to lower monthly payments regardless of total costs. This could fundamentally alter American attitudes toward debt and personal finance in ways that compound the problems these products claim to solve. From a banking system stability perspective, 50-year mortgages create concentration risks that traditional mortgages don't present. Banks holding large portfolios of half-century loans would face extended exposure to individual borrowers and specific geographic markets. Economic disruptions, demographic shifts, or local market downturns could have amplified impacts when loan terms extend across such long periods. This could make the financial system more fragile rather than more stable. The technology and automation implications are worth considering as well. Much of the mortgage industry's current infrastructure is built around 30-year loan assumptions. Payment processing systems, servicing platforms, escrow management, and regulatory reporting would all need updates to accommodate 50-year terms. These transition costs would likely be passed to borrowers, adding to the total expense of these products. Looking at the proposal through the lens of financial literacy reveals additional concerns. Many borrowers struggle to understand the implications of traditional 30-year mortgages, as evidenced by the subprime crisis and ongoing issues with adjustable rate products. 50-year mortgages add complexity that could make informed decision-making even more challenging for average consumers. The gap between apparent affordability and actual cost could lead to widespread misunderstanding of the true financial implications. The relationship between 50-year mortgages and monetary policy deserves deeper analysis. Federal Reserve officials use interest rate policy to influence economic activity, often specifically targeting housing markets through mortgage rates. 50-year mortgages could reduce the effectiveness of monetary policy by extending the duration over which interest rate changes affect borrowers. This could complicate the Fed's ability to manage economic cycles, potentially requiring more aggressive policy interventions to achieve desired effects. International capital flows present another consideration. Foreign investors who purchase American mortgage-backed securities would need to evaluate their appetite for 50-year exposure to U.S. housing markets. Changes in international demand for these securities could affect their pricing and availability, potentially making 50-year mortgages more expensive or less available than initial projections might suggest. The environmental and climate implications add yet another dimension to consider. 50-year mortgages tie borrowers to specific properties for extended periods, potentially reducing mobility and adaptation to climate change impacts. As certain geographic areas become less desirable due to sea level rise, extreme weather, or other climate-related factors, borrowers locked into long-term mortgages might face difficult choices between continuing payments on properties in declining areas or defaulting on their loans. The social mobility implications deserve attention as well. Traditional mortgages allow households to build equity over time, providing financial resources for education, business investment, or geographic relocation. 50-year mortgages significantly slow this equity-building process, potentially reducing opportunities for economic advancement and social mobility. This could contribute to increased inequality rather than reducing it, despite the apparent expansion of home ownership access. From a consumer protection standpoint, 50-year mortgages raise questions about predatory lending practices. The complexity of these products and the significant difference between apparent and actual costs could make them attractive to unscrupulous lenders seeking to exploit unsophisticated borrowers. Regulatory frameworks would need substantial updates to ensure appropriate consumer protections are in place. The housing supply implications warrant examination as well. By enabling buyers to qualify for larger loans, 50-year mortgages could put additional upward pressure on home prices, potentially exacerbating the very affordability problems they claim to address. This could create a vicious cycle where longer loan terms become necessary to afford homes that are expensive, partly because longer loan terms are available. The demographic trends affecting American households suggest that 50-year mortgages might address the wrong problem entirely. Household formation rates among younger Americans have declined, partly due to economic pressures, including housing costs. Rather than enabling people to take on larger debt obligations, policies focused on increasing housing supply or reducing construction costs might more effectively address underlying affordability issues. The comparison with other countries that have implemented similar policies provides instructive lessons. In addition to Japan's experience with multi-generational mortgages, several European countries have experimented with extended loan terms during housing affordability crises. The general pattern has been that these products provide temporary relief for individual borrowers while contributing to broader market distortions that ultimately worsen affordability problems. The actuarial assumptions underlying 50-year mortgages become particularly important when considering climate change, technological disruption, and demographic shifts. Lenders must make assumptions about property values, borrower mortality rates, and economic conditions across half-century timeframes. The uncertainty inherent in such long-term projections could lead to either inadequate risk pricing that creates systemic vulnerabilities or excessive risk pricing that negates the affordability benefits these products are meant to provide. The relationship between 50-year mortgages and retirement planning presents additional challenges. Traditional financial planning assumes that housing costs decrease in retirement as mortgages are paid off. 50-year mortgages would mean that many borrowers continue making mortgage payments throughout retirement, requiring higher retirement savings to maintain living standards. This could strain already inadequate retirement savings among American households. Perhaps most fundamentally, the proposal reflects a broader shift in how American society thinks about debt and financial obligations. The normalization of lifelong debt payments represents a significant departure from traditional economic thinking that viewed debt as a temporary tool for acquiring assets. This philosophical shift could have implications that extend far beyond housing markets, affecting everything from entrepreneurship to family formation to retirement planning. The implementation timeline for such a policy would also present practical challenges. Current mortgage industry infrastructure, regulatory frameworks, and market practices are all built around traditional loan terms. Transitioning to accommodate 50-year mortgages would require coordinated changes across multiple industries and regulatory agencies, creating opportunities for errors and unintended consequences. Looking at this proposal in the context of American economic history, it represents the latest iteration of a recurring pattern where financial innovation is used to maintain consumption patterns in the face of declining affordability. From installment buying in the 1920s to credit cards in the 1960s to subprime mortgages in the 2000s, each innovation has temporarily expanded access to goods and services while creating new forms of financial vulnerability. In the end, this proposal serves as a fascinating case study in how American economic policy often approaches complex problems through financial innovation rather than structural reform. Whether this represents pragmatic problem solving or the avoidance of more difficult policy questions may depend on your perspective. What's clear is that the mathematics of 50-year mortgages work much better for lenders than they do for borrowers, which perhaps tells us everything we need to know about whose interests are really being served. The ultimate irony may be that a policy designed to make homeownership more accessible could end up making it less sustainable, creating new forms of financial instability while failing to address the underlying causes of housing unaffordability. But then again, that wouldn't be the first time well-intentioned financial policy produced unintended consequences that were somehow more beneficial to the financial industry than to the people it was meant to help. The housing supply implications warrant examination as well. By enabling buyers to qualify for larger loans, 50-year mortgages could put additional upward pressure on home prices, potentially exacerbating the very affordability problems they claim to address. This could create a vicious cycle where longer loan terms become necessary to afford homes that are expensive, partly because longer loan terms are available. The demographic trends affecting American households suggest that 50-year mortgages might address the wrong problem entirely. Household formation rates among younger Americans have declined, partly due to economic pressures, including housing costs. Rather than enabling people to take on larger debt obligations, policies focused on increasing housing supply or reducing construction costs might more effectively address underlying affordability issues.